Okay, good morning. This is we're in the end phase of the course. It's going to be fun to see how much of this interesting theory you've reviewed and learned again maybe can be applied to what's happening. I tried to update these slides as best as I could. So these are really, I'm going to give you sort of the state of the art in the European Monetary Union in an hour and a half. So the idea is simply to continue our discussion from last time, how the European monetary system was sort of an effort by the European Union to stabilize the real exchange rate between countries that are already quite integrated, sometimes, as we saw last week, so integrated that the price levels of related countries or neighboring countries move together, and that the statistical evidence on the shocks hitting these regions are sometimes quite correlated, meaning that the basic Mundell conditions for monetary union are met. But of course, there are other things to worry about, and also we wanted to get the Southern European flank in the union, which meant that they needed to do a little bit more work, and we'll see about that today. The Maastricht Treaty is an effort to make sure that countries obey the fundamental conditions for being part of the monetary union. But before we get there, we'd like to talk about the workings of this European monetary system one more time, the exchange rate mechanism, the intervention mechanism, and why it collapsed. There was a series of speculative attacks. You've probably read about it or heard about it, the famous the exit of the pound in 1993, or 92 actually, and the temporary exit of Italy in 1993 from the European monetary intervention mechanism, and then the return of Italy and Southern Europe, but the exit of Britain, which turned out to culminate in Brexit, which was the exit of Britain from the European Union. We'll talk about why these things happen, because ultimately it's a matter of whether countries can understand whether they want their own monetary policy or not. And if they can't really get that straight, then they're always going to have problems. And yet there's another problem on top of that, is if you have end countries participating in a monetary union, in a monetary system with fixed exchange rates, you're always going to have some asymmetry arising, a hegemony problem of one country being a little bit too large relative to the others. And if these countries that participate in the exchange rate mechanism don't accept that, it can lead to conflicts. And this is why the speculative attacks arose, and possibly why the euro had to be introduced. Otherwise, Europe would have degenerated to the situation that was prevalent in the 1970s again. Okay, so I'll talk about that as a way of leading up to the Maastricht Treaty and explaining how the Maastricht Treaty, in the first instance, dealt with the establishment of a central bank, a fantastic experiment that's had never really been done, a central bank that is in charge of monetary affairs for a union of countries, not just for a single country. So we have Germany has a monetary union, has had a monetary union since the unification of Germany in the 1870s, and establishing a common currency is kind of an obvious way to do that. But the congruence or the coincidence of the nation state with the monetary union in this particular case, in the case of the European Monetary Union, is not the case. So the countries had to agree on this. A lot of negotiation had to happen, and a lot of countries have had to change their attitudes towards fiscal and monetary policy, especially monetary policy, obviously giving up the right to control monetary affairs directly through the old central bank. So, going back and thinking about what we did learn last time, we talked about the gold standard as being the ultimate exchange rate system that's fixed, very easy to understand, very hard to maintain because the national temptation is to cheat a little bit, and if you have capital immobility, if it's very difficult to move ownership claims across national borders, central banks like the United Kingdom and the United States were able to exploit their centrality in this gold standard system to increase the money supply on their own and not have to necessarily lose gold as a result. Okay, so that was kind of the thing that led up to the establishment of the Bretton Woods system, which is seen as a gold exchange standard, in a sense allowing the central banks in total to create money on their own without attachment to gold, but still having gold there as sort of something to look at and pretend that there was something disciplining monetary policy. As we saw, the 1960s showed us that this was not the case. Eventually, the United States exhausted its free degree of freedom and perhaps you might say extended itself and leading to a very large monetary expansion that Europe and Japan was not willing to sort of bear. And we saw in the last lecture that there was quite a large monetary expansion that resulted in the 1960s and 70s, which in the early 1970s resulted in the collapse of the Bretton Woods system. And in its place, the European monetary system was founded. I'll talk about that now. Okay, so the fixed exchange rate regime was really a great source of security for Europe for two reasons. First, it established fixed exchange rates within the European trading regime. It also provided for monetary stability, and the US dollar was kind of the guarantor. And European countries were willing for a long time to hold that foreign exchange. And after the oil shocks, it became clear that the dollar was losing value, not just in terms of goods and services, but in terms of gold, because the price of gold on world markets was increasing rapidly. And it was inconsistent with a $35 an ounce price. Okay, so the response of Europe was to say, look, we have to deal with this because floating exchange rates, the volatility implied, as we saw last week, is just inconsistent with a free trading, an European integration in the sense that this course has tried to push. And there you see Giscard d'Estaing and Helmut Schmidt meeting in 1978 to announce that Europe was going to introduce this system, but the way they did it was very clever. It was basically France and Germany saying, we're going to do this, and if you want, you can join us. So this is probably the way Europe moves forward. Two large players get together and say, let's cut a deal, and we're going to make it so inviting that other people, other countries, other nations will join. And this was the famous Brussels summit in 1978. Before that, there was a meeting in Paris. That's the first prelude to having some reaction. And the French were, of course, pushing very hard to establish Europe's independence, as it is wont to do. But it really came to a fruition after the extreme fluctuations after the first oil price shock and the inflation that ensued, that the European Monetary Union or monetary system was in the cards. Monetary union had already been talked about in the early 1970s with the Werner report, but not taken very seriously. And it was clear that to get to a monetary union, you had to have fixed exchange rates for a long time. Europe has to really sort of get used to the idea of getting rid of its money. No more guilders, no more Belgian francs, no more French francs. Big step for the French, and no more pesetas and drachmas and punts. Okay, and no more D-mark. Okay, so getting rid of all of this was a big deal. You're too young to even be able to remember what it was like. The discussion around losing the D-mark was a big political football in this country, but in every country it was a football. Every populist party wanted to increase their votes by appealing to people's sense of nationalism, and it was actually quite effective in some countries. Okay, but anyway, it happened. Okay, and the question is, how is it structured? We talked about it last time. You need to have something to be fixing to, and what are you going to use? No gold, right? So the obvious thing is we're going to invent something. So we invent an écu. This écu was the grandfather of the euro. Okay, if you think about it, no one actually thought about it at the time, but it was literally when the conversion occurred, when the introduction of the euro occurred, the exchange rate between the écu and the euro was 1-to-1, and it was done in such a clever way with futures contracts and forward trading intervention by the national central banks to make sure that on the day the euro was introduced, 1 euro equals 1 écu. And what is an écu? An écu is literally a basket of pieces of paper of different currency units. So if you think money is worthless, this is worthless. But we know that money is worth something because people believe it's worth something and you can spend it. And to be a part of this club, you got to do the right thing. You know, if you want to become a member of the fixed exchange rate regime, you have to have low inflation, so you have to have a credible currency. Think about it. This is Munchausen. You're literally fixing your exchange rate to a basket of currencies of which your own currency is a member. So it's just a system of linear equations, and you can solve it because you're all taking linear algebra. You invert the matrix. It does work, and that's how you get the bilateral exchange rates. The most important thing is, how do you establish the parities? The parities have to be established in negotiation. How much does écu cost in D-marks, and how much does an écu cost in French francs? Okay? And those parities are political because they mean setting the exchange rate now and possibly forever if you don't change it. And if it's a credible system, you don't change it. Of course, occasionally you change it. Devaluation goes down. Appreciation, revaluation goes up. But those are set by the central bank. The central bank has to intervene in the national currency to buy and sell the foreign currencies to maintain those bilateral exchange rates that are applied by this system of linear equations. Okay? So that's already a tall order. It means every central bank has to have a trading desk, and a big one, and be able to deal with all these banks that are coming and trying to buy and sell foreign exchange against the national currency. Okay? It is possible. It worked for 20 years. Okay? So it was a good system, I think. But it requires a lot of effort, and you need to have this decision-making process when the parities can be changed, because if you think there's going to be a devaluation of the French franc, everyone wants to unload their French francs. In fact, people like George Soros would borrow money in France and buy D-marks. Short selling. You even short sell and use your short sales revenues to buy the currency you think is going to appreciate. So if you do this revaluation, as they called it, doesn't mean de or appreciation, it could just mean a revaluation. You do it on the weekend. So the finance ministers would get into planes and fly to some remote island and hammer it out, and the press, of course, was totally stupid, never found out about it. They did find out about it. So people knew these things were happening on the weekend. And now people trade foreign exchange over the weekend. They're trading 24/7. Trillions of dollars of foreign exchange are traded every day. The volume right now is about 5 trillion US dollars, the world foreign exchange market. So the central banks better get their act together if they're going to fight against this. Now, they make the market in their own currency, so it's possible, but they have to coordinate. And the finance ministers actually aren't supposed to be telling the central bankers what to do, but that's the way it is when you're in a fixed exchange rate regime, because you don't have a monetary policy. It all makes perfect sense. Okay? This was the composition of the initial écu in 1979 when it was introduced. Okay, so it was literally a basket. Think of a basket with little bits of, and I have some of these currencies in my pot in my office. You know, I have all these little coins, and you can think of it that way. Of course, in real terms, it was just a set of numbers, weights, okay? But once you construct those weights and you take a point in time like March 1979, you can construct the relative share, okay, of the value at market prices of these these currencies in this écu. And you can see that the German mark was about a third, and that corresponded to the size of the German economy in the European Union at the time. Since then, it's become a little bit smaller because the European Union has gotten bigger. Non-German EU has gotten bigger faster than Germany has gotten. Okay, so for 20 years, the ministers would get together and say, hey, it's about time you increased our weight in the écu, or we decreased our weight. I mean, this is complete nonsense to think that it's a national point of national pride, but it was obviously an issue for trading nations, open countries with exposure to the exchange rate. So you can see that the British pound was in, even though the European monetary system did not have the English, or the UK as a player. The UK was a member of the EU at the time, and was until the exit 2 years ago. And in fact, we also see other currencies you've never heard of, like the Irish punt. So all the members had to be in, even if they didn't want to participate in the fixed exchange rate regime. All right? So what good does that do? If you take any bilateral, these are all highly traded currencies at the time. They were highly traded, so you could instantly get a quote for dollars. And therefore, you could compute bilateral exchange rates across any sort of number of dimensions. And that led to the matrix that you're about to see. That matrix basically is consisting of a central parity defined with respect to the AQ at its midpoint, and then plus or minus a band of variation of 2.25%. So the central banks were obliged to make sure that the exchange rate didn't deviate from those above or below those intervention points. Now, of course, the Italians got a special deal. They were 15% plus minus. In this particular, that's because of the Italian special features, which we still see today. Okay, but in any case, you can see all the details at the bottom. And if you want to learn more about this, look in the book. There's a great summary of that because my co-author Charles Wiplows is really an expert on this. But the interesting thing is to understand why this is important because, you know, as I said before, if you adopt a fixed exchange rate regime like the European exchange rate mechanism, you basically don't have any monetary policy. You have to intervene. And you intervene as a central bank with the foreign assets in the balance sheet at the upper left. Okay? And that has monetary consequences. If there's a run on your currency, you have to sell your domestic, your foreign currency and buy back the domestic currency. You're contracting the money supply. You're literally destroying the liabilities of the central bank, and that destroys the commercial bank's liquidity, ability to lend, and that has an effect on M1 and M2. So the money supply is endogenous, as I've told you many times before. So just to remind you, instead of gold, we have the AQ. And with those minimal number of lines, you can derive all the cross rates just by division, okay? And just like in gold, any deviations from those implied bilateral rates would lead to infinite profit possibilities. So the markets were very, very attentive to make sure that the traded rates did not deviate from the implied parity too much, because otherwise you could make a fortune, especially if you thought maybe there was going to be a devaluation. Okay? Just make sure you understand that. Okay? This is called the impossible trinity. The fact that you have to give up your freedom. I think Bevin talked about this last week. The 1992 project also implied that you could take your money and park it in a French bank without any French bureaucrat looking at you, and you could borrow money in France and put it in Germany. That's called capital mobility, financial capital mobility, not just physical capital mobility. So that implies that there's potentially infinite demand and supply of currency that has to be satisfied if you have a serious exchange rate that's a serious fixed exchange rate regime. So that means that there's no monetary dependence because the central bank has to be fixated on keeping this monetary policy. Now, the problem was German unification came up. Okay, and German unification was an asymmetric shock to Germany. German unification. Hundreds of billions of dollars had to be spent on investing, building up East Germany. You're too young to understand how bad it looked in East Germany in 1989. It was pretty run down. A lot of pollution, a lot of environmental destruction, and a lot of very, very old and decrepit enterprises that needed capital, physical capital. Okay, so that meant there was a big investment boom, a big shock to Germany, unified Germany, and what happens then? We'll talk about it in just a second. But this is the problem. Who gets to react, and how does a union of fixed exchange rate participating economies react to that shock? Okay? So I'm going to tell you about the N-1 problem. When you have capital mobility and you have fixed exchange rate regimes, you have an extra degree of freedom. You have an extra degree of freedom, which I'm going to call the nth problem. Okay, basically, there are N-1 central parities that are sufficient to define the last one. Again, think of the triangles and the arrows that I just drew before. Okay, I have a picture to show you this, but the fundamental theorem is if there are n currencies, and if there are n central parities with respect to the to this AQ basket, then there are naturally a certain number of cross-exchange rates, which you can use the combinatorial formula. N-1 divided by 2 is the number of cross exchange rates that need to be managed, but you don't need to have that many. Okay, it turns out that you can actually get away with n-1, and you can still draw all the implied bilateral parities. So in some sense, there is an nth degree of freedom that this union of central banks trying to maintain a fixed exchange rate has. Somebody has to control the overall monetary policy of the fixed exchange rate system. Now, who is that going to be? Luxembourg? Belgium? Italy? What do you think? Probably the big country, the hegemon, especially if that country wants tight monetary policy. That's the obvious conclusion that a lot of countries understood immediately following unification. But it took a few crises, i.e. 1992 September, George Soros, and 1993, exit of Italy and Finland and other countries from the narrow band, to make it happen. So who determines overall monetary policy in a monetary fixed exchange rate mechanism? It's an open question. Just like the United States was determining monetary policy for the Bretton Woods system, because it was the hegemon. So my theory is it's not just necessarily the tight monetary policy. It helps to have tight monetary policy because people are buying your currency and you can accumulate reserves as long as you want. But eventually, you can say, I'm finished now. I'm going to raise interest rates because the money supply is growing too fast. Otherwise you have an indeterminate monetary policy. Munchausen is not exactly Munchausen. He can pull himself out of the swamp, but you can't determine his position. Somebody has to push him in one direction or the other, okay? So this is the n-1th problem. It is possible for a single central bank to control monetary policy in this regime. Now, I know a lot of people who were Bundesbanking back in the 1990s. Some of them are still around, and they will all deny this. Okay, but it's true. There's no question. And the French were acutely aware of that. Because if the French wanted to tighten monetary policy or change monetary policy, it was a different kettle of fish than if the Germans wanted to do so. Germany is the largest economy, okay? And it also has a preference against inflation, has a preference for low inflation. So it's just natural that the Germans would get the nth degree of freedom. So it's a little bit like the privilège exorbitant of the 1970s or 1960s that the French were complaining about. But back then it was different because everybody wanted to have the dollar as a reserve currency, and the dollar is sort of an anchor of stability. Hola. But it's the asymmetry in the intervention that matters. The intervention system is asymmetric because if you have the tight monetary policy, if you have higher interest rates, what's happening? You were the one who nailed it last time, right? That was really a great answer. I don't know if you remember, but you really nailed it. Why do we have national central banks in the European monetary system? Why is it easier to raise interest rates in a fixed exchange rate regime if you can? We said you can't, but suppose one country does. In a fixed exchange rate regime, fixed exchange rate regime. Think of the Bundesbank in 1990. German economy is booming, inflation's rising. The Bundesbank doesn't like inflation. They're in a monetary fixed exchange rate regime. They're not supposed to have an independent monetary policy. But they say, well, we're going to fight inflation anyway. We're going to raise interest rates. We're going to move along our Taylor rule. Okay, what happens?
The other central banks also have to raise their interest rates to keep the exchange rates fixed.
Right, because they are losing Deutsche Mark. They're intervening to keep their currency from depreciating. In Germany, interest rates are rising. This has actually happened. I was there. Everyone's rushing in to put money in German banks and take advantage of these high German interest rates. short-term capital that you can pull back after 3 months. Okay? So the D-mark was appreciating, and it's not supposed to do that in a fixed exchange rate regime. And according to the treaty, the Germans would sell D-marks, and the French would buy the French francs back. Okay? But doing that means contraction in France, means raising interest rates in France. And that's painful for the French. They didn't unify. Why should they worry about the interest rate? You know, this is a German problem. No, in a monetary fixed exchange rate regime, it's everyone's problem. Okay, you can draw this using ISTR curves easily. You know, it's Mundell-Fleming like you learned last week. Okay, so think about this diagram. What does that mean? That means that the Deutsche Mark has a little bit of independence in as much as it is raising interest rates. And it's big enough to do so. I mean, if a small country raises interest rates, it'll cause a Switzerland effect. I'll show you this. Denmark had the problem with in 2010 when Frau Merkel said that had to say that German savings accounts were okay, but the reason why she did that is because people were running away to Denmark. Okay, fixed exchange rate regime. But Denmark is a small, tiny country, right? So this is the problem. The Germans just fix to the ECU, and basically they can, if they want, they can raise interest rates, and they're big enough to do so they can determine the tone of monetary policy in the entire union. Okay, so this is called the N-1 problem, and it was the reason the French, and not just the French, but all the other countries said, unification is fine, we'll let you do this, but I think it's time to have a common currency. And this is something else that every finance minister will deny, and every person who worked at the Bundesbank will deny. But why did Karl Otto Perl resign? The famous Karl Otto Perl was the head of the Bundesbank, and when German unification occurred, monetary union with the Ostmark, he resigned. Can't ask him anymore, he's not around, but he was not pleased. The Bundesbank lost its autonomy, so in some sense the Germans had the ability to raise interest rates, and he was kind of the embodiment of that ability, but the political pressure was so great that, and eventually they adopted, they went to the Maastricht Treaty as a solution to this problem. So this is all about speculative crises, okay? We know that the reason this happened was that in 1991, 92, pressure on the D-mark was going up, was building, and the German central bank was buying up these foreign currencies in the European monetary system and increasing the money supply at a rate that it was not happy with. Okay? And just want to remind you how that works. This is all about speculative attacks. So in our textbook, we talk about it in the European integration textbook. There's a nice chapter about it. There's so-called first-generation models and there's second-generation models. We'll start with the first generation. The idea is very simple. Going back to the balance sheet, if you consolidate the central bank with the commercial banks, you can see what's going on. It's a matter of domestic credit. Okay, domestic credit is basically the asset side of the money supply. Domestic credit plus foreign exchange reserves. Okay, so consolidation is simply putting these two central banks together, the central bank and the commercial banking sector together, and you can see on the left-hand side, on the asset side, we've got foreign assets, call that F, and call this pink stuff DC, domestic credit. Credit to the government, credit to the private sector, the real sector, credit to households. Okay? And the flip side of that is simply the money supply. So I can reduce this by getting rid of all the other stuff, get rid of net worth, just to make it easy to understand, right? So basically, when you're in a fixed exchange rate regime, you have no control over the money supply. All you can do is perhaps control the composition of the asset side on the balance sheet of the consolidated banking sector. So if you try to tighten monetary policy, you'll get an inflow of foreign assets, and you'll have to raise interest rates, and you'll contract domestic credit. Similarly, if you try to expand domestic credit, you're going to cause interest rates to be lower, and that's going to drive away foreign exchange because people are going to be selling your currency. Interest rates are too low. So that's the problem with having fixed exchange rates. If you want to control your money supply, you can't. Okay? Unfortunately, some countries have tried through history to break this law. Okay, so one was Britain. Britain tried to do that. This is what would happen if you tried to increase domestic credit, just like, I never read Baldwin Whiplow's, I'm going to try this and see what happens. Well, if the money supply is endogenously determined at M, and I'm just going to hold it fixed, then an increase in DC means that R has to fall, just by double entry bookkeeping. And you can see what's happening. If the Bank of England just tries very hard to keep increasing domestic credit through all sorts of monetary policy mechanisms we understand, then eventually it's going to run out of reserves. It will no longer be able to fix the D-mark, pound sterling exchange rate. And that's exactly what happened. This is a theoretical picture. Now you can see that if you just extrapolate, you end up at point A. At the t implied by point A, you run out of reserves. But that's not the way it really works. What happens is the markets anticipate you're going to run out of reserves. And when you run out of reserves, you're going to go on your own exchange rate, interest rates will rise, and then you'll basically have a lower demand for money. And that means that the actual attack takes place before point A. Okay? And this is exactly what happened with Great Britain. So this is the exact path of reserves when George Soros and the other hedge funds attacked pound sterling by borrowing in the UK, where interest rates were low, and buying the D-mark in the hope that eventually this would happen. So Britain was losing its reserves, the pink line is falling, and then we had this crisis, and then Britain went off the peg, stopped pegging its exchange rate, interest rates rose, the Bank of England started to replenish its foreign exchange reserves. It didn't have to fix the currency anymore, so it could buy back its currency. So that's the so-called first generation. The second generation is even more interesting because it means that possibly the anticipation of an exit from an exchange rate regime could cause an attack. Okay, so it's like it's we call a self-fulfilling prophecy. So imagine if people anticipated the central bank would not react to a speculative attack by raising interest rates to fight the attack, to fight George Soros. And there are two good examples of that. One is the UK and the other is Sweden. Okay, just Sweden was also participating in a similar mechanism. And basically the idea is what happens. If you raise interest rates, you run your economy into the ground. You deter the attack, but it means there's a lot of political pain. If markets think that you're not willing to do that, then they're going to attack you. And in a sense, even if you're not really so weak, maybe you have enough reserves, but the markets anticipate the political pressure will be too great, then they might attack you anyway. So there's almost like a multiple equilibrium. It's like a bank run. In fact, it's very similar. The model is very similar to a bank run. Okay? So just to give you an idea, after all the smoke clears, after these 20 years before the euro was introduced, many countries entered and left the fixed exchange rate regime. Okay, they left because they went into the euro. One exception was Denmark. The other exception is Sweden, which left the fixed exchange rate and wanted to have its own currency, its own monetary policy. Okay, there are a lot of other euro countries, EU countries that have the option to join, but still, Poland is an example. Hungary, Czech Republic. The Bulgarians would like to join, but I think there's still a bit of a reluctance on the part of the ECB has taken a lot on, even just took on Croatia. Okay, so, actually the kuna doesn't even exist anymore. The kuna was just absorbed by the euro. If you go to visit lovely Croatia, you'll use euros now instead of the famous kuna. So you have insiders and outsiders, and you still have Denmark, which is the poster child for a fixed exchange rate regime that works, because the Danes have said, okay, we're going to have our ugly central bank, but we're just going to use it as a trading desk and monitor the Danish banks to make sure they don't make bad loans. But in general, we're a fixed exchange rate fan, okay? Well, we know already from our last lecture that there are disadvantages and advantages, and I just want to remind you of what they are. Fixed exchange rates have exactly what Denmark wanted to take advantage of, buffer against financial shocks, but if there's a boom in Denmark, it's going to be a big one because there'll be capital inflows, and they have a very stable crown euro real exchange rate. So the relative price level in Denmark and Germany is incredibly stable. Go on vacation there. It's more expensive, but it's been more expensive for a couple of decades now. It's a wealthy country. If you have flexible exchange rate, you have the advantage of having your own monetary authority, autonomy. It does buffer against real shocks. You have an appreciation if you have a boom at home, or a depreciation if you have a recession, but it leads to inefficient hedging. Let's look at Denmark just to give you an idea of how interesting this can be. So here's Denmark. The exchange rate of the Danish crown relative to the euro after 1999 or before, it was called the écu, remember? 1-to-1. So what do you see? And I've written it S inverse. Why did I do that? Ever since I've taught economics, and I taught to a lot of people, the Italians have the best conceptualization of the exchange rate. They can really think of exchange rates very readily, and that's because the Italian city-states in the 15th century were very good at this, okay? And sometimes we're a little bit slower. Why do I have S inverse? Because that's the way they do it. The Danes have always asked how many crowns, our stuff, do we need to buy one of their things? Euro. It's called European terms. You should probably write that down. British terms is how much of their stuff does 1 unit of our stuff cost. And that's the way the euro is quoted. How many dollars does it cost to buy a euro? So it's all, one is an inverse of another, but a lot of times people don't get it. The nice thing about the other way, the way we do it, is that if it goes up, it's an appreciation, right? And you can see here, it's going down. That's an appreciation of the crown. And that's why I have S minus to the -1 power. You see lots of volatility before, and afterwards you see a flat line. It's almost as if the Danes adopted the euro. They are taking it seriously. This is the poster child of a successful, well-organized participant in a fixed exchange rate regime. No monetary authority. We don't even have an illusion of having it, but we certainly want to have that fixed exchange rate regime. So I put it in S form. It looks like this. And you can see that there was a big appreciation and then seriousness. Okay, so what do you think? The cost of doing this means that your balance sheet, you lose control of your balance sheet. Is that what you're going to say?
No, I have a question. Is there an advantage for Denmark for having their own currency now, other than national pride?
That's the greatest question. Ask your nearest Danish friend. Why don't we just throw that out there? Why would they want to, I mean, all this, you asked the same question about the central banks. Why bother? Well, what was my answer back then? Option value. Ultimately, Europeans don't trust each other. That's my conclusion. As an American, I conclude that after all these wars, after all these invasions, Europeans still don't trust each other because Germany was not willing to get rid of the Bundesbank, and Denmark is still not really willing to get rid of the Nationalbank, the Danske Nationalbank, because who knows, maybe we're not going to get along so well, and we want to have our own. It's easier to do it if you already got the bank there. If you have to start it from scratch, painful. Then you can say, where are you going to put it? Berlin? Put it in Frankfurt? Put it in Aarhus? I mean, so that's my interpretation. Maybe you have a different one. But it's a great question. Everyone asks that question. Also, the people who work for the National Bank of Denmark, the central bank, also have a nice job, and there are many of them. You don't want to get rid of it. Maybe someday there'll be a shortage of people in other professions and occupations. Just, yeah.
Maybe the question is a bit digression, but how can the American monetary history be compared to the European monetary history? Because the Federal Reserve also was created way, like, I don't know, I think.
1913.
Yeah, it was more than 100 years after the United States.
Yeah, so the United States has a very interesting relationship with banks. Politicians have always bashed the banks. and attempts to start a national bank of the United States were always squashed. The U.S. Treasury has had the function of creating means of payment, and because they were on the gold standard, it was just a matter of minting the coins. You know, the Treasury would take the gold and make the coins, and you can take the coin home and play with it and spend it, whatever. And the banks were issuing banknotes, so you had private issue of bank liabilities, which were used as means of payment. Imagine that. You know, say you go to a restaurant, you whip out a Deutsche Bank banknote and pay for your dinner. That actually happened. But you had to know, well, what's the exchange rate between a Deutsche Bank banknote and a Commerzbank banknote? You have to have a market, maybe a catalog of prices or someone making a market. So this is one of the disadvantages of having private banking. And the same question is, use cryptocurrencies. It's the same thing, right, in a modern context. So private issue is an issue. And the United States didn't have a central bank for many years. Andrew Jackson, the idol of Donald Trump, also was totally against a national bank. And I think, you know, it's not completely unreasonable because national banks are a source of financing for wars and all sorts of other nonsense. So if you can get your hands on a central bank, good job. Napoleon did it, a bunch of other people did. And the United States refused to have a central bank or abolished it. And the Civil War was an interesting situation because you had two United States. So you had the Confederate States and the Northern States, and currency issue was a big issue for the South. So they had their own, I think it was a central bank actually. So in other words, 1913 was a watershed in the United States because it meant that this detachment from having a central issue of currency and taking control over the money supply for good reasons to harmonize financial conditions for agriculture was a good idea. Smooth interest rates over the cycle. But you asked the right question. Where are the central banks located, and what are the central banks? So in the United States, the Fed is centered around cities. There are 12 cities that are the centers of the Federal Reserve districts, and they have nothing to do with the states. So California cannot hit up the San Francisco Fed for a loan. And that's what Europe should have done. Because ultimately, if Germany wants to borrow money, they shouldn't have to be able to go to the Bundesbank and organize some purchase of bonds, or more importantly, the Bank of Italy, asking the Italian government to buy some of their bonds, because this is kind of cheating. We're skipping the gun, but it's a great question, great topic, and still open source of contention within Europe. Okay, so here's the flip side of this. So remember I told you fixed exchange rate, you have to buy and sell whatever people come to you with. So the Central Bank of Denmark had to buy a lot of foreign exchange. And when did this happen? After the financial crisis. Germans started to freak out because a lot of big German banks were in trouble. A lot of big German banks had lent to Greece, but especially to Ireland, right? And they were worried, my money is in trouble, so I'm going to go to Denmark, just across the border, okay? And the Danish had much less exposure and free capital movement, so you don't see a bump in the exchange rate here, you just see a bump in the reserves. This is to really help you understand what it means to have a fixed exchange rate regime like the Danes do. So doing it like the Danes do, I mean, you lose control over, and this meant that basically a lot more liquidity in the Danish market. House prices start to rise. This is not good for Danish stability. Ultimately, banks get really excited and start lending money at very low interest rates. Price of real estate goes up. So you have some risks, right? And this will come back to us maybe later, we talk about it. Okay, so just to give you an idea, this is a wonderful picture. Keep it in mind. Yeah, so again, this simplification is kind of useful for you to think about, and maybe you should keep it in mind. If we go back and think about the speculative attacks of the 1990s, it made sense for countries really to ask the question, what conditions do we need? We want to have low inflation. We want to have low debt. We don't want to have pressure points where the national government can come to the central bank and say, hey, we're in trouble, can you help us? You know, this happened many times already. It happened in Greece, happened in a lot of southern European countries. So, you know, given the inflation record up until the late 1970s, it was an important issue because we know ultimately some countries have high inflation and some countries had low inflation. So different preferences. So EMS actually did have some successes. It helped stabilize inflation. It stabilized real interest rates, real exchange rates, and realignments became less and less frequent. So France and Germany, it was a matter of national pride not to have a devaluation. So after Mitterrand, after the late 1980s, there were very, very few revaluations between Germany and France. And that meant that basically the real exchange rate became more stable. Okay, maybe not so much for other countries, but in the end, interest rates became lower because people expected lower inflation, and they would expect lower, they would ask for lower nominal interest rates on their loans. And you can see this from the French experience. So France really became credible as a result of the EMS. And you can argue that a lot of other countries did as well. But still, you had this N-1 problem, and the French kept saying, hey, it's not right that the Germans get to call the shots on monetary policy. You know, maybe there is kind of a booming economy, but why do they get to call the shots in the Bundesbank? Now, if I were French, I would understand that. And I lived in France before this happened, I understood that, okay? It's this feeling of helplessness. And some people say, oh, it's a feeling of comfort because, you know, Mother Germany's taking care of me. But, you know, Europeans are funny. I already said it. They've been fighting for centuries. There's got to be a better way, okay? So a monetary union is kind of an obvious full Monty going all the way, common currency. Let's get it out of the way. Let's do the United States. And we already talked about the conditions for a monetary union. I will talk about them in detail in 1 week. The preconditions you can imagine, right? It's been tried before. So this is not a unique experiment in the sense of a common currency. It is a unique experiment in respect to a central bank, okay? Because Karl der Große tried this in the 9th century. Okay, so this guy was no dummy. You know, unfortunately back then, it was like, you know, you disagree with me, I cut your head off. You know, I just take over and kill all your people and make them my slaves. Okay, that's the way things were working back then. But in terms of economic relations, Charlemagne was pretty smart. There was an edict where he basically said, you have to accept my money. And it has this value, it's this amount of silver, and I'm going to establish the coinage centers in my kingdom. So as he took over countries, he would basically establish cities as being centers of coinage. So you could bring your silver, and he said, no gold standards, too rare. We're going to use silver. So the guy was pretty smart. Right? So you bring in the silver, and then make the coins, and you take them home, and you can spend them. Okay? So serious monetary union. Didn't last because when Charlemagne died, his sons all fought against each other, and it collapsed. Too bad. It was a try. But people argue it was a pretty good idea at the time. So fast forward to 1990, after the unification episode, the Eurozone pressure in Germany. I used to actually give a whole lecture on this, but it's not worth it. You can do it with ISTR. You can see what happened. Basically led to this resentment of the nth degree of freedom being controlled by Germany, and it meant that but Germany came back and said, look, okay, we love Europe so much, and you let us reunify, but you have to do it on our terms. What was the first term? You got to commit to low inflation. So how do you do that? Well, obviously we've learned that one way to increase inflation is to increase the money supply for a long time. And where does that come from? It comes from budget deficits of the government. I mean, it's just common sense. And people will deny that, but ultimately long-run inflation is a function of growth in the money supply or a central bank that's willing to set a target rate of inflation that's high enough to make sure that you get that inflation rate. Okay, so so the Germans said, look, we'll do this, but we're going to have on our terms. What's the other term? What's the other condition? That's another way of implementing this idea, making sure that countries don't borrow too much money, a ratio restriction on debt to GDP or deficits to GDP. We'll talk about that in a couple of weeks. But the symbolic, what is a symbolic gesture that the French caved at some point? They realized they had to do it. Yeah, yeah, got to be in Frankfurt. Frankfurt, the center of German finance. Used to be Berlin. 100 years ago, it was not Frankfurt, it was Berlin, right? But Frankfurt, Bundesbank, stability, it just made sense. And the German government, of course, was very happy about that and said, okay, you're going to do that, we'll consider it. We'll even give you a piece of real estate on the east side of Frankfurt, and we'll make this worth your while. They built this huge tower, cathedral of monetary solidity. If you have a chance to go visit, it's really, really interesting. It's very impressive. Great view if you can get up to the top and look out. But most importantly, the Germans insisted on these preconditions. So this is going to be a club. You can join, but you have to meet these conditions, like joining the Freemasons. You know, they have to want you, and you also have to fulfill some conditions. Okay, so there it is. That's the treaty, and that's Maastricht, which is not a really super old ancient city, but it's pretty interesting. It's got a great university, and they decided to meet there. So it put the city on the map, basically. Okay, so a treaty on the European Union was signed in February '92, and it actually took effect in '93. It was not just about the central bank; it was about other stuff, European cooperation. So on the surface, it was about cooperation on police, defense policy, common European passport. A lot of interesting aspects, but most importantly, it laid the conditions for a monetary union. It didn't actually implement it. It just said, we're going to have this roadmap, and if this roadmap is fulfilled, we will go the full 9 yards and do it. Okay, so think of Maastricht as really, and everyone talks about the Maastricht criteria. I will talk about them now. Basically, as a way of establishing the conditions that we get into it's like getting married. You know, you don't get married immediately. You have to sort of try it out a little bit and make sure everything's working, and make sure two people can actually stand each other. Okay, so that's one way of thinking about it. So we have stages. The first stage is basically capital mobility. So you're actually exposing yourself to the very factor that can cause your downturn, that caused the downfall of the UK fixed exchange rate with Germany, capital mobility. So you're saying, George Soros, come, do whatever you want. You know, if a bank wants to lend money to you and you want to put it somewhere else, that's fine. We're not going to stop you. Now, a lot of people thought that was bad, but enforcing capital restrictions is already a very difficult proposition in Europe. There are no capital restrictions between Louisiana and Texas, right? So it's difficult to imagine how would you even implement that? And people will be coming across with their suitcases with cash. Forget it, right? In a modern world with some degree of freedom, and I mean that in the literal sense, we don't want to have that. So this puts discipline on the national governments, right? And stage 2 meant basically increased cooperation, the foundation of a European Monetary Institute in Frankfurt to get things going in 1995, and increasing alignment of economic policy. So we have to start talking and exchanging data, because before that, there wasn't much data being exchanged. I mean, it wasn't like a free thing. The OECD was forcing countries to exchange data, but the French and the Germans weren't having consultations. I mean, this is a very new thing. And then stage 3 is the most important, would be the introduction of the euro in the sense of a bookkeeping euro, and then in 2002, the introduction of banknotes. Okay, so it was quite a roadmap. And then the steps have to be met with respect to requirements for euro membership. So these so-called Maastricht criteria, and there are 5 of them that you should remember. Okay, so these criteria are basically club membership rules, right? And now, here they are. Inflation, Every country that wants to be in the Euro club is going to have their inflation rate be less than the average of the lowest 3 inflation countries at the point of the foundational point, plus 1.5%, 150 basis points. So that's a tight band. Take the lowest 3, average it, and then add on 150 points, 1.5%. Tough. Okay, so, okay, can we do that? Well, I told you that Greece had 26% inflation in 1989 or 1990. Okay, so it's a long way to come down, and we know that's very, very painful. So it's going to take at least 10 years, and it did take 10 years. Long-term interest rates. So the long-term interest rate on a 10-year bond has to be less than the average of the 3 lowest inflation rate countries' interest rates plus 2%, 200 basis points. So why would they look at long-run interest rates, long-term interest rates, 10-year treasury bonds or government debt? The nice thing is everybody's got 10-year government debt, so you can compare it. So why would you want to look at that?
So do you mean that they took the average of the last 10 years of the interest?
No, the last 3 years, the average of the 3 countries with the lowest inflation rates, take their 10-year interest rates and average them, and then tack on 200 basis points. So why would they look at nominal interest rates? Nominal long-term interest rates. I'm giving you the hints. Yeah.
Can't you see how stable that country and that country is
If you lend money to a government for 10 years, in nominal terms, I mean, you're going to get I back, 1 plus I to the 10th power for every euro you give it. What happens if the inflation rate is twice I in the future? You don't know what it's going to be because it's the future. It's expectations of inflation. So the long-term interest rate today of a German 10-year nominal bond is a reflection of people's expectations, lenders' expectations of German inflation for the next 10 years, as well as their expectation of the real return on the investment. That's what the Fisher principle says. So basically, this brilliant condition says we're going to make sure the markets are convinced that this is not just a joke or a scam. All right, so it's the market condition. And that means the central bank can't just go in there and manipulate the market. They can't just lower the interest rate. That's just the current interest rate. The long one is the one that people are trading in the market for. So if you think that Germany is going to have a high inflation rate, then people will sell the bond, the interest rates will go up. The nominal yield on that bond will go up. You understand how that works. You took Macro 1 and Macro 2. Okay? So this is a great condition, tough as hell, because if a country doesn't have a good reputation, even though it has low interest rates now, it could have 10-year interest rates that are 10-year bond rate yields that are quite high. Okay, so getting that down means you have to convince the public, the trading public, that you're serious about inflation. Everybody understand that? Condition number 3, government debt. So you mentioned it already, very good. The debt is the sum of all the deficits that a government has run since the beginning of its existence. All right, so it's the sum of all the indebtedness, not to be confused with the deficit. That's the next condition. But the debt, the sum of national debt. So you have to consolidate. It's kind of tricky because you have German government debt, federal government debt, you have state debt, you have local debt. You've got to put it all together because you want to have people cooking the books. And you also have off-balance budget stuff. We learned about the Sondervermögen, which is kind of interesting. They call it a Vermögen, even though it's debt. So you're issuing debt to get a lot of money together so you can invest it in the environment or national defense. Sondervermögen, yeah? So learn that. It's a fun word, even if you don't speak German. All that together, 60%, because that's what the government will have to ultimately have to pay. Why divided by GDP? Big countries have larger capacities to repay or to service. We'll see in 2 weeks, you don't have to repay the debt. You just have to service it. Because if you're growing, you can service a larger quantity of debt. So that's why the ratio is important. That's the easy, light version of what I'm going to tell you in 2 weeks. Question? So I talked about the debt, but the Germans were so strict, they said, we're going to also look at the deficit. So criteria number 4 is the deficit. So it's the flow of new indebtedness. We're going to try to restrict that as well. So think of it as a balloon. The size of the balloon, when you blow it up, is the debt, and then the flow of your air going in as you blow it up is the deficit. Right? So we want to control you in 2 different ways. They're kind of related to each other. We'll see that in a couple of weeks, but the Germans are control freaks. Let's do this. I say that a bit ironically. Actually, a lot of other people in Europe were interested in this Maastricht criterion, especially Northern Europeans from the Netherlands, from Belgium, from Finland, from Sweden, etc. What's the final condition? Who wants to guess it? Maybe you saw the video. It's the most obvious one. If we want to go into a monetary union bed and I've got an exchange rate before, what do I have to do before I get into bed? I have to credibly fix the exchange rate for a certain number of periods, a certain amount of time. Now, for some reason, they decided to make this 3 years. I have no idea, and I think sometimes they've played around with this. They've loosened it. So it's these are like rules for joining the club, but maybe if you meet the other criteria, we'll let you in. This one means that if you, for example, Croatia, in joining the European Monetary Union, which they have done, means that they had to keep their exchange rate within the band, like I showed you before, like Denmark still does to this day, within 2 plus or minus 2.25 points. Okay? So they have to really do that in a credible way, which means they give up their monetary authority or monetary autonomy even 2 or 3 years before the beginning of this exercise. Okay, so Maastricht looks like a very cumbersome set of rules. It's an entry requirement, and the question is what happens after the countries join? You know how it is, once you join, you're a member now, you can do whatever you want. So this is another issue that we have to deal with. We'll talk about it later, because there are ways to violate the Maastricht conditions. Once you've joined, there is no restriction effectively on your behavior. This is an entry rule. You had a question?
It is. One question is, there are countries like Montenegro that just took the euro as their currency. Was it just something that the European Union allowed, or what was that?
I missed the first part?
There's like countries like Montenegro
Yeah.
that took the euro as their own currency.
Yes. These are the wild cases, right? So Montenegro, there are a lot of countries that use the euro and were never invited to and they do, and the European Central Bank is probably delighted because that increases their profitability. In some sense, they have there's a natural demand for reserve currency abroad, and Montenegro will have to export to Europe to get those euros. It is true, and there's several other cases. I mean, Bosnia, I think, is also co-using euro. Eventually, these countries, hopefully, when the Balkans join the European Union, I think we'll have, Albanians using the euro as well. But let's take it easy right now. Let's wait. Okay, so the restrictions look like really tough to meet, and you're right. We'll understand them, and we'll understand why they were loosened, in the sense that once you got into the club, we're not going to make Germany have 3% maximum deficit as a fraction of GDP, because Germany itself violated that rule. So Germany and France in 2003-04, they violated their own rules, but it wasn't an entry criterion because they're already in the euro. So they kind of paved the way for all the other problems we had. The 2 biggest countries basically said, don't worry about it. So no one thought about that. Maybe they did think about it, but they didn't want to politicize it or make it an issue. It's what the Germans call vollendete Tatsachen. So you do something and then there's nothing you can do about it. Okay, but we want to prevent this in the future, and that's why the Stability and Growth Pact is in successor forms is a way of trying to still force people after the fact to kind of obey the rules, i.e. don't run excessive deficits. Don't try to freeload on the EU or on the European Central Bank to get them to buy your debt and to finance your deficits. I'm giving you the crude form. We'll talk about it formally in 2 weeks from now. Okay, so I mean, we'll talk about the common currency and the conditions for a single currency, the so-called optimal currency area, next week. So let me give you some details about this institution. It is really amazing. I still stand in wonderment when I go to Frankfurt and look at this building, and when I think about all the work the Europeans did to make this happen. It's really a true effort at European integration that transcends governments. And it still offers the only option for Europe to actually act as a whole, as a unit. And it acted in the pandemic, it acted in response to the first financial crisis, and it acted in response to the war in Ukraine. So it created the central bank. And the central bank is actually not completely finished. It's a Baustelle in German. It's still a place where they're still hammering out the details. Why? Because it's supposed to have all the European Union is supposed to be participating in this European Central Bank project. And a lot of countries have said, no, we don't want to do that. They've opted out, at least temporarily. So the official usage of the word is the temporary opt-out and the option of joining. Okay, so now that the UK is out of the EU, this is no longer a real serious issue. Most countries have said someday we will use the euro. We just have to be ready and sure that we want it. And of course, we're in a democracy, in a democratic system. Every country gets to decide. I think that's completely fine. You shouldn't force people to use money they don't want to use. So that means we have a European system of central banks which transcends, which is bigger than the European Central Bank. Okay, so the Bank of Poland, for example, the National Bank of Poland, the National Bank of Hungary, the Central Bank of the Czech Republic, Slovenia now actually uses the euro. That's a mistake. So, you have this sort of patchwork of participating. But these countries are so small that they really have to pay attention to the euro, and they are almost, if they're not actually fixing the exchange rate, they've managed to peg the inflation rate to a similar inflation rate that's prevailing in the European Union. So they've effectively fixed the real exchange rate. So we talk about the euro system would be basically the European of central banks that actually use the euro. Okay, and then again you have these fringe countries, like you said. Montenegro is kind of a strange place. Not to denigrate Montenegro, but they really either they're in or they're out, and I don't know why. Maybe someday they will be in. They got to join the European Union first. Okay, so this is kind of what it looks like. You've got this governing council, which is a union of the executive board, the people that really actually do the heavy lifting, and then you've got the governors of the national central banks that are participating in the euro, and they comprise the governing council, and the governing council, extended by the governors of the non-participating central banks, makes the general council. Okay, so let me just go through these institutions. They're very important. The general council consists of the ECB president, vice president, and the governors of the national central banks of the 27 member states. So it was 28 until the UK left. Okay, they basically discuss the transition. They don't meet so frequently because it's not so clear that everybody that's out still wants to join, but they still have to discuss financial stability, banking regulation, and the like, because it's all about monetary. So even if they're not using the euro, they really care about what the euro is doing. They care about bank regulation in the euro area. It's a great quotation I got from the website. This is what they look like. There's so many people in this governing council, I'm not even going to try to name them, okay? This general council, okay? Now, the one that you hear about when you read the newspaper or you hear about when you listen to the radio is basically the governing council. And this is the one that takes the decisions on the interest rates. Okay, so think of the decision-making body. So we have the 6 members of the executive board, and then you've got a representative of each national central bank that's using the euro. There's 19 of those right now. They formulate monetary policy, reserve requirements if they exist, and the implementation of those decisions, general guidelines. They also think about banking supervision. This is new since the financial crisis. The ECB has a big role in regulating financially relevant, systemically relevant banks, financial institutions. And they draft decisions that the supervisory board draws up under the non-objection procedure. If you want to learn more about that, please click on the website. Here they are, and I'm pleased to say there are more women than there were a few years ago, but there still aren't enough. And these have to be rotated out because occasionally a Baltic state will have a woman as a central bank chairman and then she'll disappear. But you see the very important people are female. Okay, one is Christine Lagarde and the other is Isabel Schnabel. Okay, so France and Germany represented. Christine Lagarde is the president of the European Central Bank. Therefore, she's the head of the executive board. Okay, and there are no explicit written rules on who gets to play here, because this is the one that really matters. Day-to-day decisions, implementation of policy decisions, all that it takes, Mario Draghi. So the big countries that tend to be more often represented, Germany and France kind of have a permanent ticket, although it's not really expressly stated based on their GDP weight. We see a fairly high presence of Benelux countries and the Italians, and then occasionally a Dane or a Baltic person will show up. Okay, so don't ask me how this is done. It's a matter for the European Commission and the European Parliament. So the responsibility is to prepare the meetings, of course, but also to do implementation of monetary policy, doing the hard nuts and bolts, making day-to-day decisions, which are extremely important. Okay, watching the dollar, arranging for lines of credit in case of emergencies with the United States or the Bank of Japan, and of course to exercise powers that the Governing Council may deem appropriate to delegate. Here they are, those lovely people, very important people, not elected directly, but nominated by democratic means, and I think that's fair enough to say that it's good to insulate them from too much pressure. The guy on the left is the chief economist, Philip Lane. That was in 2020. Look what happened in 2021. Social distancing. I think it's a great picture. It's very nice. It looks like they're aliens coming in, Star Trek or something. Okay, so let's spend the last 15 minutes talking about European Central Bank monetary policy. Remember, price stability is the ECB rule. I taught you that in Macro 1, right? Price stability means a rate of change of the price level that is not greater than 2% per year. That's a statement, but it's been stated so much and so often it sounds like a credible objective. We've had some inflation recently. So did they fail? Well, they're certainly doing something about it. I'll tell you about it in a second. But it's impossible to directly manipulate the inflation rate without extreme costs. So you have to accept deviations, and the question is, are they doing the job? So how do you do your job? You do it through the instruments that are given to you. Refinancing interest rates. What interest rate do you charge for refinancing with commercial banks? And this is usually with an eye to a local market interest rate. It was the Ionia. The Ionia doesn't exist anymore. Now I'll show you a picture in a second. And for a long time, the Germans wanted to insist on a monetary target in addition to an inflation target. So the Germans really wanted to, they're just fixated on this money supply. Okay, maybe there's a good reason for that. Maybe there's an additional disciplining device, but we know that it's sufficient to have a target rate of inflation that you take seriously, but at least in the beginning, in the first decade of the euro's existence, the Germans were talking about inflation and the monetary target. Okay? In the meantime, we hardly ever talk about the monetary pillar, but we talk a lot about the inflation target. So the Germans should be happy, right? They're getting what they want. Now, how do you implement policy? Well, we learned that in Macro too. There are 3 ways. What are they? Anybody? Nah, I mean, you're always telling me the answer. Anybody else? 3 mechanisms of monetary policy. How does the ECB do it? Policy interest rates, it's actually up there. I know you can read. Policy interest rates and open market operations, and what's the third one? Reserve requirements. So they can put their heavy hand in there and say, look, you can't lend more than this amount of reserves that you have parked at my central bank. Okay? But people don't do that much anymore because it's kind of, it's a burden on the banks. It's a tax on the banks because you're basically neutralizing part of their balance sheet. They can't invest it in interest yielding, competitive interest yielding assets. Okay, so this is the beginning. These are the good old days. Inflation was low, the euro was pretty stable, things were looking great. Okay, the euro seems to follow. The European Central Bank seems to follow a Taylor rule. Remember the Taylor rule? And it can because it has an independent monetary policy. Okay, so Europe has its own monetary policy. It's not pegging to the dollar. It's not pegging to the ruble. It's not pegging to the British pound. It's doing what it wants. It wants to stabilize inflation, and therefore it has a Taylor rule. So if you understood the Taylor rule, we now have it, and everyone gets to play by the Taylor rule. Europe as a whole. Not the Bundesbank, not the Bank of France. They don't have any say in this anymore. All they do is basically execute monetary policy. Remember that. The Bundesbank has no power anymore. The only power it has is to yell at the national central bank policy meetings. And sometimes it gets listened to, sometimes it doesn't, right? It has a bit more vote because they also have more presence in the executive board. Then we have the financial crisis. Now, how do you think about the financial crisis? What was the most important long-term effect or the medium-term effect of the financial crisis for you? And you were around when this happened. You were getting interested in economics. You were reading the newspaper, reading about interest rates. The striking thing about the financial crisis is that interest rates fell. And I like to think about it as a shift of the IS curve to the left, but a significant one, and also an increase in central banks' willingness to lower the interest rate to stimulate the economy and save the banking system. Rightward shift of the TR curve. That means very low interest rates. So low that they're bouncing off the floor. It's called the zero lower bound. Okay, so here's your picture. I've updated this. Look at this. Okay, the market rates are negative. So banks were actually trading with each other, reserves with each other, at a negative interest rate. I'm paying you to take my money because I'm kind of maybe scared that something's going to happen. I don't want to have too much of this exposure. In any case, the European Central Bank was also penalizing banks that parked their money with them. Right? So money was kind of like a hot potato. When I say money, I mean reserves. Okay, so this is a curious time for us economists. Very difficult for us to explain. Paul Krugman wrote some very, very interesting articles to explain the perversity of economic relations between banks when you have these kind of conditions. But they were not permanent. because underlying this nominal interest rate, which is 0 or negative, is an inflation rate and a real interest rate, which is also very low. They can't be low forever. And sure enough, we have left the zero lower bound. And because of the war in the Ukraine and the increase in energy prices caused a spike in inflation, and suddenly the ECB discovers that it's an inflation fighter, and it raises interest rates by 350 basis points. That's a lot. Actually, it raises it by 400 basis points if you look at depending on how you define it, okay? So we have three rates. We have this upper rate, which is the marginal lending rate for banks that are really kind of desperate, possibly without the appropriate collateral in an emergency. And the middle rate, the blue rate, is when you have appropriate collateral, so-called main refinancing rate. That's the one we always pay attention to. And the lower one is the deposit facility. If you, a bank, park your money at the ECB, you get interest, and you can see that it's negative up until the summer of 22, and then it skyrockets. So now people are trying to banks are trying to take their money, and park it in a interest-bearing facility. The problem was they borrowed a lot of money from the ECB at rates that are less attractive now. So what we have is sort of an inversion, and I'll show this to you in a second with respect to open market operations. But let's just take a look at this final beautiful picture that my research assistant generated for me. You can see there are two interest rates. The Ionia ceases to exist because there was a scandal involving how they actually collected those data. So now we have a different interest rate that we're looking at, which is the European short-term interest rate. You can see that it also spikes. That's the actual rate at which banks lend to each other, okay? So the flip side of this is the other monetary policy tool, which is open market operations. Okay, so when interest rates hit the floor, the central bank said, we got to do something. What are we going to do? We're going to start buying debt on the open market. So we're going to increase the size of the balance sheet using the operations that we've talked about the entire 3 lectures previous. Expansionary monetary policy. So here's the balance sheet in 2004. It's worth studying, especially when you look at the bottom line, the size of the balance sheet, the sum of the balance sheet, some of all the assets and liabilities of the Euro system, meaning the central banks, all the central banks. And for my purposes, this is the ECB, because the European Central Bank is owned by the Bundesbank, the Banque de France. They still exist, and they do open market operations on behalf of Christine Lagarde and Isabel Schnabel. Okay? So see if you can get that. Actually, they own it. So the German central bank, the Deutsche Bundesbank, owns the ECB, a piece of the action, and they get a piece of the profits. Where do the profits come from? Because everything on the left-hand side potentially has a yield, an interest, some sort of investment income, and that's a lot of money. Hundreds of, 50 billion euros. So, if you're a finance minister, you want to take advantage of that and even plan for your budget. So you can see this is a long time ago. This is after the financial crisis. What do you notice? The length of the balance sheet has doubled. It doesn't double by accident. The central bank has complete control over its balance sheet. So it goes to market, it lends to banks, or it buys securities on the open market. And if banks don't want to borrow from you, you buy securities on the open market because that's the only market in town. This is 2012. So look at the change. It's already increased another almost by 80% again. And then what happened? Then we come into 2013, and it's falling from 3 trillion to 2.3 trillion. What's going on here? Banks were actually using the proceeds from Actually, the bond purchase program had ceased, and the banks were starting to repay their so-called long-term refinancing operations. So it's shrinking. If you look very carefully, when you take this home and look at it, the difference that's really important is borrowing by the banks from the central bank. They started to repay their loan. So the balance sheet of the ECB was shrinking. This is not a good thing for an economy trying to recover from the worst financial crisis since the Great Depression. This is when Mario says, all that it takes. All that it takes meant I'm going to buy whatever I need to boost the balance sheet size to be consistent with enough liquidity in the economy. So by 2017, you can see the difference from 2.3 trillion to 4.5 trillion. So literally in 4 years, a doubling of the size of the balance sheet. And again, when the economy starts to slow down, the size of the money supply may start to shrink. You know, in case because the demand for money depends on the interest rate, it depends on economic activity. When economic activity declines, the demand for money declines as well. So if you like balance sheets as much as I do, look what happened in the pandemic. The ECB was called upon to actually support where the national governments of the EU were unable to do so, to support lending to firms and to governments. And they started taking a lot of paper, buying a lot of paper on the market that was not government debt. Okay? So a lot of people got really worked up about that. Oh, it's terrible. You know, this is the end of the world. But, you know, if they do due diligence and check properly, this is not commercial paper of Porto soccer club or something, and it's going to be okay. So by the end of the pandemic, the balance sheet got even bigger. So people are getting worried about, you know, inflationary expectations and inflationary possibilities. But actually, since the Russian war, the balance sheet has started to moderate in terms of growth. So between 22 and 23, it actually shrank. And this is in response to the increase in inflation. So monetary tightness, raising the interest rates, and at the same time, open market sales, or not retiring. When the bonds come due, they don't actually go out and buy new bonds. They just take the money, and the money supply shrinks. So the money supply is elastic. Don't let anyone fool you. Either you control the money supply, or you control interest rates. You can't control both. And if you want to see the data, this is last year when I taught this course. So you can see the blue line is the total sum of the balance sheet, and this is after the war started. And inflation picked up, and the ECB got serious about inflation. So I'm fairly optimistic that the ECB can handle what's happening. And if you look at the recent decisions of the governing council and the executive board, this would support my assessment. So you look at this and you still get nervous because it's growing exponentially. But our economy is growing exponentially, and the money supply is growing exponentially. So you take logs. Taking logs is the right thing to do. What happens? You remember, you're economists. Take logs on the time diagram, and the slope of that curve is the rate of growth. So things look okay. I'm sanguine about the future of the euro. Okay? You had a question. You probably forgot it.
Do you think that this steep interest rate increase will have a real effect on the real economy?
I do. I think it's happening. I think we're in a recession now. It's a technical recession. Germany has some other issues that we'll talk about later, next 2 weeks. It's the high energy prices is a supply shock, and a supply shock implies real economic changes. We're going to have to use less energy. We're going to have to move towards, renewable energy. Germany has this real shock. No cheap Russian gas anymore. No cheap Russian oil. So we're all going to have to accept a lower standard of living in some form or another. And inflation is one way that happens. Inflation that we don't get to recoup with higher wages and higher rates of profit. Okay? So a little bit, could be good news if Southern Europe suddenly becomes the the new center of economic activity because they have lots of sunshine and they develop lots of hydrogen producing facilities and lots of solar energy. We'll see. Okay, so if that happens, maybe Europe will become unified and integrated after all. I couldn't have given this lecture 2 years ago. Things were very different back then. We were in the middle of a pandemic and I was on a screen, okay? Okay, so I'm sorry I took you a little bit longer, but lots of key concepts to think about. Please remember the 3 tools of monetary policy and remember how the European Central Bank has executed them in the past couple of years. Okay, have a great week and I'll see you next time.